New Year. Welcome to the 2023 China's Overseas Development Finance Database webinar, hosted by the Boston University Global Development Policy Center. The Boston University Global Development Policy Center, or GDP Center, is a university-wide research center that works to advance policy-oriented research for financial stability, human well-being, and environmental sustainability across the globe. My name is Cecilia Springer, and I'm the Assistant Director of the Global China Initiative within the GDP Center. The Global China Initiative examines China's overseas economic activity and engagement, and in particular, our research has a focus on data analysis for transparency and accountability. The Global China Initiative manages a suite of interactive public databases that collectively track hundreds of billions of dollars in Chinese loans and investment to a variety of sectors. These databases aim to provide transparent information to aid research, education, policymaking, journalism, and accountability with regards to China's overseas development finance and projects around the world. Today, we are very excited to share our update of the China's Overseas Development Finance Database, or CODF. The CODF database is the first global, harmonized, validated, and geolocated record of China's overseas development finance. And now covering the years 2008 through the end of 2021, the database includes loan commitments from China's development finance institutions, the China Development Bank and the Export-Import Bank of China, to public borrowers overseas. There is also an interactive mapping of the proximity of projects to three types of ecologically sensitive territories: indigenous peoples' lands, national protected areas, and critical habitats. Since peaking in 2016, China's overseas development finance has continually declined. We also know that as China's overseas development finance has fallen in total value, so too has the average loan commitment size and the physical size of the projects. This trend is emblematic of a new approach of China's economic engagement in recent years, and our team will explain a lot more about this shortly. So today's webinar will ask, what is the status of China's overseas development finance? Looking forward, how likely is China to return to large-scale lending levels? And how has this pivot towards smaller projects affected the environmental and social risks associated with China's overseas development finance? So we are joined by two of our lead researchers on China's overseas development finance, as well as our center's director, who will provide commentary and reactions on the findings. And just to briefly introduce our team here today, we have Kevin Gallagher, who is the director of the Boston University Global Development Policy Center. We have Rebecca Ray, or Becky, who is our senior academic researcher at the GDP Center. And we have Oyen Taralado Moses, or Tarala for short, the data analyst and database manager for the Global China Initiative at the GDP Center. So to begin, Becky will present key findings, followed by a database demonstration by Tarala. And after that, we will have a discussion session among our panelists, followed by a Q&A session with the audience. So before turning it over to the speakers, I want to mention that this webinar is being live streamed on YouTube, so recording will be immediately accessible afterwards. And when it comes time for audience Q&A, please use the Q&A box located in your Zoom menu to ask your questions, and also give your name and affiliation so we can get to know each other. And please feel free to enter your questions at any time during the discussion. I'll keep a note and we can bunch them together during the Q&A session. Thank you, everybody. And now over to you, Becky.
Thank you so much, Cecilia, for that introduction. It's great to be able to share with you some of the top findings of our research. In fact, there are 4 findings in particular I'd like to go over today. The first is the rise of this frame of small is beautiful, that we see not only a significant decline in the aggregate amount of lending, as Cecilia mentioned, but also in the size of the average project that's being supported in the last few years. Then I'll put that in context with what we see from countries' borrowings from other development finance institutions, using the World Bank as an example. Next, I'll turn to what the differences and the changes over time tell us about the environmental and social risks intrinsic in the projects that China's development finance is supporting. And finally, I'll end with a few thoughts about potential future prospects, where we'll go from here. But first, To briefly introduce the CODF dataset to attendees who may not have used it before, as Cecilia said, we track from 2008, the last global business cycle peak, through 2021, $498 billion in nearly 1,100 commitments from CDB and EXIM Bank, or CHEXIM, as we call it here, to 100 countries around the world. That's about 83% of what the World Bank lent to those countries in the same time period. So the same echelon, though not quite the same level. Here we see a geographic mapping of those 100 countries. 10 in particular are labeled, and those top 10 borrowers account for over half, 59% of all of the CDB and CHEXIM commitments over this time. So when you hear about Chinese overseas lending, there's a better than even chance you'll be hearing about it in this context. Now, 5 of these borrowers have major state-owned oil or gas companies. From left to right, that's Ecuador, Venezuela, Brazil, Angola, and Russia. Those companies, just by themselves, if they were a country, they would be the top borrower in the data set over this whole time period. But Chinese development finance hasn't supported those firms in the last several years. And that brings us to our first finding, this pivot to the framing of small is beautiful. Now, as Cecilia mentioned earlier, when we look at the aggregate amount of China's overseas development finance, we can see it here graphed in blue, the number of commitments, and in red, the total committed amount in billions of US dollars. There is, of course, a tremendous decline since the peak in 2016. However, in tandem to that, we see a shift on average to supporting smaller projects. And here I have 3 different ways of thinking about the size of projects. First, on the left, average loan value, simply the average amount of millions of US dollars in a particular commitment. Second, the average length of physical linear projects that are supported. And linear projects here are things like roads, power lines, pipelines, which can be measured in kilometers. And finally, we have polygon projects, which are area-based projects like reservoirs for dams or mines or industrial complexes, which you can measure in square kilometers. Now, in each of these 3 ways of measuring size, I've got it split out by time period. We have the first 5 years of the data set from 2008 to 2012, which corresponds with the 5 years before the Belt and Road Initiative was announced in 2013. We have the first 5 years of the BRI from 2013 to 2017, and we have the most recent years. In each of these cases, that second time period, the first few years of the BRI, shows a tremendous growth into larger projects on average. But the last few years have shown a decline back to the average level of where things were before the BRI. This is particularly true for polygon projects, though I should note that that includes some reservoirs that haven't finished filling up yet. So physically, those projects are expected to expand a little bit in the coming years. But overall, the trend is quite consistent in this shift towards the Chinese frame of small is beautiful. Now, let's put that in context in our finding 2, in comparison with other traditional sources of development finance. And here I'll use the World Bank as an example, given its global membership. Here we see a global map of borrowing from the World Bank in blue, juxtaposed with borrowing from China in red over the same time period. We have a distribution graph on the left showing the number of countries first who borrowed from the World Bank, but nothing from China, that's 47 countries, and then a declining number of countries as you get to higher concentrations of Chinese borrowing. There are only 6 countries that borrowed from China, but not the World Bank. Most countries are in these middle categories of borrowing from both. And in fact, among the 100 countries that have borrowed some from China, the overwhelming majority, 72, have borrowed about the same from the World Bank or borrowed significantly more from the World Bank. So given the chance to borrow from China and the chance to borrow from the World Bank, these countries are saying yes to both. And in fact, I have 4 countries labeled here. These 4 countries are among those top 10 China borrowers I showed at the beginning. And even they are right there in that middle category, borrowing about the same from each. So even among China's top borrowers, this is a story of yes and rather than a story of either or. However, borrowers are taking different kinds of projects to different lenders. Here we have the sectoral breakdown of commitments from the World Bank in blue and from China in red over the study time period. What really jumps out here is that tall blue line in the middle, the overwhelming majority of World Bank lending goes to these traditional public administration sectors of health, education, institutional capacity building, whereas countries are going to China for infrastructure and extraction and other industrial projects for immediate economic growth. So we see countries simply taking different projects to different lenders. That's why it's so important that we consider the environmental and social risk profile of Chinese overseas development finance, because it's more likely to be associated with projects that have geographic footprints. So our next finding is about those risks in particular. To help stakeholders, governments, both Chinese and host country, as well as community groups, manage these projects as well as possible, the CODF dataset precisely geolocates 736 projects in 85 countries around the world. We also track 3 types of geographically sensitive territories, as Cecilia mentioned at the beginning: potential or likely critical habitats for global biodiversity conservation, indigenous peoples' lands, and protected areas. Of course, this doesn't cover every kind of environmentally and socially sensitive risk that we should be taking into account, but they do have globally harmonized definitions, which allows us to consider and compare how these overlaps change across countries and across time with a harmonized framework. And here's what we see. This shows the entire study period and the percent of committed finance that went first into projects that overlap with critical habitats, that's 47% of committed finance, indigenous peoples' land in gold, that's 28, and protected areas, that's 30. We then have these declining bars that show 36% of committed finance went to mappable projects, went to projects that didn't have any overlap, and then fewer that had overlap with 1 type, 2 types, or all 3 types of sensitive territories. On the right, we have the overall Venn diagram of all of the overlaps. What I want to draw your attention to here is the difference in the size of these bars. Almost half of Chinese development finance went into projects that overlap with critical habitats, whereas only 25 to 30% went into projects that overlap with indigenous peoples' lands or protected areas. That's not because critical habitats take up a greater share of the world's territory. In fact, both critical habitats and protected areas take up about 15% of the world's territory. So why the big difference? Well, what is different among this type of territory is host country legal protection. By definition, protected areas are protected. They're delineated and managed for conservation. Critical habitats are recognized by conservation biologists for their importance, but don't necessarily have any host country protections. So this really reinforces the importance and necessity for BRI host countries to set and enforce their own environmental and social standards, because China's overseas development finance is sensitive to those differences. Now, this has changed over time. Just as the size of loans changed over time, so too have these overlaps. Here I've broken out that Venn diagram by the same time periods I showed you before. And what I want to draw your attention to here is that middle square. Those areas really expand to fill up almost the entire square. Only 29% of committed finance to mappable physical projects in that time period, in the first few years of the BRI, only 29% went to projects that didn't overlap with one of these kinds of sensitive territories. And again, likely or potential critical habitats, protected areas, these only take up about 15% of the world's surface. So this is highly disproportional. But in the last few years, we've seen this tremendous shrinking of the overlap as China has focused more on smaller and more targeted support for smaller projects with less geographic footprints. Now, thinking of trends, I want to spend my last moment or two thinking about future prospects, where we might go from here. Like any bilateral relationship, China's overseas development finance depends on both China's and host countries' capacity and incentives for pursuing additional finance. China's capacity has been rebounding in the last few years. Here's what I mean by that. We frequently get asked, why has China's development finance shrunk so much in the last few years? And there's many answers to that question, but one big one is simply their supply of dollars. Here we have the same red line I've shown you in previous graphs, the total of China's overseas development finance, juxtaposed with a blue line, which is China's current account surplus, simply their exports minus their imports. This is their supply of dollars. As you can see from 2009 through 2018, these two tracked each other quite closely, even in the years of significant decline. However, in the last few years, China's account surplus has rebounded. That's the capacity. But of course, capacity isn't everything. Incentives matter too. And here we see that China's had significantly reduced incentives to be lending abroad during the COVID-19 era, when it had ample incentives to focus those dollars inward towards domestic priorities. Host countries have the opposite situation. They may have rebounding incentives to invest in infrastructure and industry, to start their economies again, to get back to growth after the COVID-19 pandemic, but they have reduced capacity to take on additional debt, both because of existing debt overhangs, because of rising global interest rates, the rising value of the US dollar. Debt is getting more and more expensive for them. So we have this misaligned situation between China and host countries, and this is what I'll be watching as we look at potential for whether China's overseas development finance will rebound in the future, or whether it will stay small, whether it will continue to focus on small projects, or if it'll rebound to those larger ones we saw in the first few years of the BRI. Thank you so much. I'll stop here and let Tarella show us more about the data set itself.
Thank you, Becky. Let me just share my screen here to show you the database interactive itself. Hopefully everyone can see my screen. And so this is the China's Overseas Development Finance Database Interactive. When you come to the website, you'll be met with a welcome page that provides information and background about the data set itself. You could scroll down to gain additional information, or just click Explore to go directly to the database. When you go into the database, you'll be met immediately with a map. And this map has the 736 projects that Becky mentioned that have precise geolocation. So as you can see, there are multiple pins that have that specifically pin projects that have been financed by China's development finance institutions. If you hover over one of these pins, you'll be able to get quick insight into a specific project. But you could also move over to this square box right here and create a shape over the map to zoom in to a specific area on the map to see where a project is located. So let me click on this globe on the right side here to go back to full map view and come over to my left to this legend area to kind of explain how you can further interact with the map. So as you can see, different projects on the map overlap with different sensitive territories. And you can click into these check boxes on the side here. So let me just move over 1 second. To click on specific finance projects that overlap with a certain sensitive territory. You could also click down here into these map layer checkboxes to see the spatial representation of these sensitive territories. So if I clicked on all these checkboxes, I will see how indigenous peoples' lands, potential critical habitats, and national protected areas are represented spatially on the map. So if I click back into all of these check boxes here and clear the map layer so we have a clear representation of the map, I'll just talk briefly about this graph at the bottom here as well. This graph kind of depicts, the number of projects that have received finance, but you can also click on this icon here to see the actual finance that has been provided by China's DFIs from 2008 to 2021. If you scroll down further, you'll be able to see the specific projects listed out according to country. You can click on this arrow here to collapse or expand projects that have received finance in each country. For each entry or finance project, you'll be able to see the year that the loan agreement was signed, the amount that was provided in finance, the lender, borrower, sector, and sensitive territory overlaps. You can also click into the individual specific project, and it will automatically show it to you on the map. So let me unlock this here and go back to full map view, and then hover over to our About Data download page. So this page specifically gives, again, more information about the CODF database. If you scroll down, you'll be able to find links to our policy brief as well, which contextualizes how to understand the trends behind this data. Many of those trends which Rebecca Ray kind of shared with us today. If you scroll down further, you'll be able to go to our data download submission form. And you can use this form to send in your information, and we will automatically send you some links to download the data. On those pages that allow you to download data, you can also download a data use agreement. And that data use agreement, if you sign it and submit it back to me at odm@bu.edu, that DUA gives you access to another version of the map that shows you each project's geolocated footprints and how they overlay with the sensitive territories specifically. Through submitting that DUA, you can also get the raw data of our spatial data as well. So let me click back out from this data download page and move over to our FAQ page, where this page gives information on any questions that you may have about the databases, as well as my email if you have any questions about the data itself. And then one of the unique features about our database is that you can also kind of explore this data using Chinese. So this is a great way to understand the database in Chinese itself, or for some of you, practice your Chinese as well. So please feel free to take a look and let us know if you have any questions. Again, you can reach out to me at odm@bu.edu for any technical or data-related questions, or Maureen Height for media inquiries. And thank you so much. I hope this is helpful for your research and kind of policy-making decisions. Thank you.
Thank you so much to Tarala and Becky for helping us understand the data a little bit better. I think you'll have a sense now of our key findings, as well as how to use the database. So I do encourage everyone to go and play around with our interactive, whether in English or Chinese. So now we'll do a panel discussion to dive a bit deeper into the findings and implications of this data release. And I encourage the audience to think of your own questions and enter them in the Q&A box while we do so. So I'd like to start with, probably the first question that we ask at the end of every webinar, which is, what is the key takeaway for policymakers from the newly released data? What are the biggest policy implications? And I'd like to pose that question to Kevin to kick us off.
Thanks, Cecilia. Happy New Year's to everybody. Happy calendar New Year's. This is our first webinar for our Global China Initiative, and happy Lunar New Year. I guess the policy implications are a couple from these data. Since 2008, China has filled a real gap for developing countries, which has been a major boost to economic growth. But for policymakers in those countries now, I think these data really show that the volume of finance on offer is going to be significantly lower. I think we see a new normal here, but it may be even of higher quality. As we show here, it's at less risk of infringing on biodiversity and indigenous lands. Some of our other work and some new policies on the China end have really showed that it's going to be much less carbon intensive. And there might be other forms of finance available from China. One about maybe we could put this in a chat, but we published a study last year that shows that China has a growing array of equity funds, the Silk Road Fund, the Portuguese-speaking People's Fund, and so forth, that are increasingly available across the world. And those could play a key role right now, as obviously equity has less of an impact on debt distress. And one of the reasons why there is less Chinese finance on the host country end is because most emerging market and developing countries can't absorb much dollar denominated debt at this time. So I'd say those are the key things. The money's still available. There's not that much, might be higher quality.
Great, thank you, Kevin. I'd also like to highlight, that 2023 has already been a tumultuous year, especially in China. There are many pressing issues at home in China, from the end of the zero COVID policy to natural gas shortages. So, expanding a little bit on the policy implications, what's next for China's overseas development finance, given everything that's happening at home? Will the declining trend that Becky highlighted continue? And might there be other drivers of future trends besides, for example, the currency issues that Becky mentioned? So yeah, that's my question about, what should we expect in the future? And I'll ask Tarela and Becky to weigh in on that.
Thanks, Cecilia. I think this question kind of just links back to the different trends we're seeing in terms of China's approach to its future development finance that Becky mentioned. So while the policy brief highlights the small is beautiful approach, you do see at the same time that there is availability of funds in terms of a current account surplus that can be used to direct finance to development finance institutions that are financing development projects. So there's kind of a mismatch in terms of strategy approach and availability. However, that availability of funds is being directed for internal purposes. So I think because of that kind of mismatch, we're still in a wait and see approach. But whether or not specific development finance from China CHEXIM and China Development Bank rebounds, I think we will see a diversification of finance as well. So Kevin talked about the overseas development investment funds, which are pools of capital that can be established by public or private shareholders to extend equity for the purpose of development projects. But we could also see foreign direct investment in the form of equity investment from Chinese companies as well. And then we could also see China's development finance institutions direct their finance to regional institutions such as the African Development Bank and the Inter-American Development Bank. So there are a lot of possibilities for channeling finance through different kind of modes, but we still are waiting to see if this new approach will really determine the future of development finance trends for China.
I'd like to underline everything Tarela just said, and also say it wouldn't be surprising at all if this era of bilateral development finance institution support is complemented in the future with greater direct equity investment directly from Chinese firms, because that era of significant DFI lending allows Chinese firms an opportunity to get experience in different host country environments, operating in different regulatory environments and different economic environments that they didn't have before. And one of the justifications for the Belt and Road Initiative in its inception was to be able to lay the groundwork for greater investment in the future. And so it wouldn't be surprising if the emphasis shifts from direct lending to direct investment. And as Tarela said, these equity funds in this paper that I do hope has been put in the chat, or could be, that Tarela led on these equity funds, is an important thing to watch in the future. Another thing that I'll be watching in the future is 2023 is the year when the World Bank is beginning its process on a roadmap for what it calls evolution in its institution to be more relevant to an era when the world needs more public goods. And that is recognizing the importance of this infrastructure and industry lending. So if the World Bank reconsiders its participation in those sectors and redirects its efforts in that direction, it'll be very interesting to watch whether the World Bank and China are able to cooperate in that space. Thanks.
Yeah, thank you, Carol and Becky. I think Speaking of the World Bank and current issues, one question I want to ask about is what this means for the global debt crisis, which, as we know, is a looming crisis. And it's important to note that this database, the CODF database, does not track debt, but rather development finance in the form of lending commitments from China. But still, I think of interest probably to this audience is the ongoing debt issues. Developing countries are struggling to repay their creditors, including China, but not only China, also private lenders, multilateral development banks, and so on. At the same time, these countries are still facing a pressing need to finance infrastructure for development. So I'd like to get Kevin's thoughts. What is and what should be China's role in global debt relief?
Sure. Well, these data that we're presenting today are loan commitments, but obviously once those loans materialize, they show up as debt on the sovereign's balance sheet. These data is the result of a lot of hard work, and it's very difficult to get the maturity and everything of each one of these loans. So these shouldn't be misconstrued as the level of the country's debt. Some of these things have been paid off, especially the earlier ones. But it should be noted, of course, that these loan commitments do show up as debt on the balance sheet of the sovereign. And unfortunately, a debt crisis isn't looming. It's here. In 2023, we've already seen Ghana default and go to the common framework. Unfortunately, almost all are betting on Pakistan, Egypt, and many others over the course of the year. The International Monetary Fund and the United Nations Development Program estimate that around 68 countries are really in distress that will need some sort of relief over the next couple of years. This debt crisis is largely a function of decades of, or since 2008, sort of ultra loose monetary policy in the United States that's been really disrupted by these abrupt interest rate hikes at the end of last year, which really broke the hair on the, or was, what's the saying? It was the hair that broke the camel's back after the COVID shock, climate shocks, and Russia's war in the Ukraine. China is one of the biggest creditors that has exposure to these countries that are in the most debt distress. The largest creditor class that is exposed to these countries with debt distress are private bondholders, largely from the West. The second largest creditor class are multilateral development banks, such as the Asian Development Bank and the World Bank and so forth. And China's development finance institutions and other creditors are the third largest. And those three are the vast bulk: private bondholders, MDBs, and China. China was a leader in 2020 and 2021 of suspending debt under the Debt Service Suspension Initiative at the G20, but has thus far been reluctant to give countries the haircut they need to return to debt sustainability and to begin to recover. This is really China's first experience with debt distress at this level across the world. And history shows that the earlier you restructure, the less the costs are for both the creditor and the debtor. So it will be in China's interest to restructure debt across countries, but China shouldn't and can't do it bilaterally, because if China gives countries a haircut, then the countries won't necessarily use the money to mount a green and inclusive recovery. They might use the savings to pay back the World Bank or PayCo or Vanguard or one of the private bondholders that also holds the debt. So there really needs to be a reform of the G20 framework on debt workouts to compel all these creditor classes to come to the table and restructure debt together. And there's a real deal to be made here, because if you think about it, most of the private contracts are governed in New York and London, and the multilateral development banks, the major shareholders of the United States and other Western European countries. And so if the US and the West compelled private bondholders and MDBs to engage in exchange for China, there's a real deal to be made here. We're part of a proposal that says not only should there be those kind of sticks where the Chinese and the US and the West sort of compel these actors to restructure. But analogous to the 1990s, we advocate for a Brady bond approach, and we have a working paper on that by Ying Qian that we can put in the chat now, where the new bonds after haircuts get guaranteed, so that there's a sweetener in it as well. That worked really well during the Brady bond situation, and might be a key way to bring all these actors together. That would be such an arrangement. A Brady bond kind of swap would be particularly beneficial for China, because like in the 1990s, Chinese loans, as our database shows, these are bank loans, long-term bank loans. And so if these were converted into bonds with a haircut, this would not only help the debt sustainability of the host countries, it would also potentially help the exposure of the China Development Bank and the Export-Import Bank of China, because they could now sell those bonds on secondary markets and alleviate their own balance sheets over time. So there's a big, this is perhaps the biggest concern facing the developing world right now. We're at a moment of acute debt distress at the same time where the United Nations and others are telling us it's now or never that we have to mobilize trillions of dollars in order to meet our climate and development goals in between now and 2030. And the math just doesn't add up. There needs to be new liquidity through SDR issuances and grants and concessional finance. But even with that, we're really going to need some significant debt reduction, especially for this family of 68 countries.
Great, thank you, Kevin. I think the links to the studies that Kevin mentioned have been posted in the chat, so definitely check them out. I want to dive a little bit back into the trends from the data, especially by sector. And what we can see is that certain types of activities have seen a steep drop off in lending commitments from China in recent years, especially loans to oil companies. So I'd like to ask Becky, what are some of the sectoral trends that you're seeing? What are behind these trends? Is this part of a deliberate green shift, or is there something else going on?
Thanks. That is one of the most striking results here, is just how steep the drop off has been in those general support loans to these big state-owned oil and gas companies around the world, and some of China's top borrowers, like I said, in Ecuador, Venezuela, Brazil, Angola, and Russia. There are a few factors that I see, although undoubtedly there's more factors in addition than what I've been able to track. Some of those are China's pivot to what they call a new normal, or a consumption-led growth model, rather than the investment-led growth model that fueled their growth prior to about 10 years ago. That transition means commodities are the raw commodities that are necessary for the ever-expanding urbanization that China went through are not as crucially necessary as they had been. In other words, the speed of the increase of their access to those commodities is not as important. Another factor that we see is, as Chinese oil and gas companies have created those links with their partners in borrowing countries, we now see direct investment that has taken the place of lending. And so Chinese oil companies, Chinese gas companies are likely to be in JV partnerships and joint venture partnerships with oil and gas companies around the world, not necessarily needing to be directly supported. A third factor might simply be the rise of electric mobility within China, as China itself's domestic economy, when it comes to transport, has undergone somewhat of a shift away from gasoline-powered mobility in particular. So those are three factors that really jump out at me, because as you said, those state-owned oil and gas companies in just those 5 countries would have been the top national borrower if it was a country, but they haven't received any direct financing in the last several years. So this really does show an about face in the prioritization of different kinds of projects from the Chinese DFIs. We'll have to wait and see, particularly in light of the Russia-Ukraine conflict, whether or not Russia pivots back, but we haven't seen evidence of that yet. Thanks.
Great, thank you so much, Becky. and to all of our panelists. And we have about 20 minutes left in the webinar and a whole bunch of questions in the Q&A box. So I want to make sure we have time for our audience. So I'm seeing a few clusters of questions. And I think one thing that's coming up is sort of the scope of this database and what it tracks. A few people have asked what we know, if we know anything about state-owned commercial banks, like ICBC, China Construction Bank, Bank of China, et cetera. Some people have asked what we know about the private sector, if we track foreign direct investment, if we track state-owned enterprise activity from China. So I was wondering if first, if our researchers could lay out again the scope of this database and where some of those other actors might fit into our research more broadly. And then second, for this round of questions, we've gotten a lot of questions about alternatives that borrowing countries may have besides China's development finance institutions. So, for example, we have a question from Robert Walker on comparisons of China's spending with that of the World Bank, which that information is in the policy brief associated with this data launch. Is there any corresponding data related to spending by the United States? We have a question from Bernardo Mariani about collaboration or complementarity between what's tracked in CODF and Western global projects in developing countries, particularly the G7 Partnership for Global Infrastructure Investment, or PGII. Our senior researcher here at the GDP Center, Yan Wang, also noted that comparison with the World Bank has shown that China, in fact, has done a lot of work in addressing infrastructure bottlenecks in African countries relative to the World Bank. So we have a lot of questions about comparing China with World Bank lending, with broader infrastructure initiatives. Jacob Gunter has asked about the Global Gateway Initiative from Europe. So these alternatives that are out there is the second cluster of questions that I'd like to put forward to the team. So first, scope of this database. Second, some of the alternatives to Chinese lending. So I'll turn it over to whoever wants to answer first.
Why don't I start, and then Tarella, I know there's going to be questions that you really have the expertise on, and I want to leave enough time for that as well. And then, of course, Kevin, if you have any macro level observations on them. To be very clear, this data set tries to be as comparable as possible to what we know about development lending from major DFIs and MDBs, multilateral development banks around the world, so that researchers can compare apples to apples as easily as possible. So at the World Bank, for example, if you look at their annual reports and their records of loan commitments, that is to sovereign governments. Loans to private enterprises and equity investments in private enterprises are all managed through a separate lending window within the greater World Bank group, the International Finance Corporation, the IFC. But World Bank lending is defined as lending to sovereign governments. And so for maximum comparability, to understand how China expands development finance that's available to developing country governments, we define it this particular way. Although there are other data sets out there that track it in different ways, we are a development policy center, and we're hoping to be able to push forward and support research into development finance specifically. Regarding other state-owned Chinese banks who lend abroad, I'll leave that question to Tarella, because she really has the expertise about all of our data sets as our database manager, and can tell you more about some of these other data sets we have that go more into detail in more geographically focused areas. Regarding alternatives, I'm glad to hear this question, because one of the reasons we define the parameters of our data set as we do is to enable comparisons with other DFIs that are out there. This could be global, like the World Bank, which is what we established to be able to help that research get started, because it has global membership. But I would love to see a Western Hemisphere specialist out there compare alternatives among DFIs that are accessible within Latin America. For example, the Inter-American Development Bank, the Development Bank of Latin America, or several that are members of other regional development banks like the AIB, and even the Islamic Development Bank has membership there. So one of the reasons we present this tool to the world of researchers is for it to support your research in your regions of focus and your areas of interest in terms of disciplines. And in fact, that's also my answer to some of the questions about complementarity, is that we hope that this tool serves as an empowering platform and resource for researchers who are really interested in digging into potential areas of complementarity, particularly in these new initiatives like the PGII, like the Global Gateway. Where do we see areas of complementarity or potential growth in these new initiatives that could complement what's already out there or fill in gaps that are lacking between what we already know about? With that, I think I'll turn it over to Tarella, since you also have such deep expertise in these areas. Thanks.
Thanks, Becky. So just to start with some of our other databases and what they could provide in terms of other Chinese lending actors. In our Chinese Loans to Africa database, we do provide information on finance that has been provided by commercial banks, as well as Chinese companies and other government lenders. So that database kind of provides a different type of comprehensive overview of different lenders within the Chinese Loans to Africa kind of space. And then our China's Global Power database specifically tracks power plants that have received Chinese development finance, as well as foreign direct investment from Chinese companies as well. That specific database does not track the actual finance amounts itself. It just tracks the power plants that have received that finance. So in a way, you can get kind of an indirect understanding of foreign direct investments for power plants across the world, specifically from Chinese companies. As Becky mentioned, there are many other databases that are out there that could tell you more about actors, but our specific databases tend to focus primarily on the development finance institutions, and then in carve out ways, focus on other lenders in some of our other databases. When it comes to alternatives, specifically the Partnership for Global Infrastructure and Investment, and as well as the Global Gateway, we put together a report on comparing the Belt and Road Initiative with the PGII, which since the last kind of G7 meeting, the Global Gateway was incorporated into the PGII. And what we found is that generally on the surface level, they tend to be similar in that both initiatives are targeting kind of low to medium income countries and extending or attempting to extend finance through their different development finance and development related institutions. In that, we do recognize that the approaches to extending that finance may be slightly different, meaning that historically, China's development finance institutions have targeted projects that are kind of hard infrastructure projects such as rail, whereas going forward, it looks like the PGII, including the Global Gateway, will focus more on soft type of infrastructure projects such as telecom, health sectors. But despite these differences, we still think that there is a level of complementarity that can happen between the PGII and the BRI. And it's really up to the policymakers as well as institutions to kind of find ways to cooperate at best, and in areas where cooperation cannot be kind of reached, to pursue a healthy form of competition where this competition is leading to a better outcome for the recipient country. And then on the recipient country's side, it's a benefit for them to have, multiple different kind of options for their development, especially given vast infrastructure gaps. But it is going to be up to recipient countries to kind of find the best deal for them when it comes to financing their development projects. So I hope that kind of gives you an answer to those questions, but additional resources to explore.
Great, thank you, Becky and Tarella. And now let's move on to our next round of questions. I see A couple more questions on the data. So first from Ty from the Foreign Policy Research Institute. Ty asks, on the database, it says that 736 projects are mapped and 363 are unmapped. So what's behind this distinction? Where the geolocation, what does it mean for a project to be unmapped? So I think that's something important to note about our data. And we also have a question from Juan about, did you find that the transparency of the Chinese development finance institutions lends itself well to comparison with others? Wondering if you could talk about any challenges with transparency, if any. I think this will be a good question for our researchers who know exactly how much work it goes into this to make data comparable. We also have some questions, sort of the bigger picture landscape of the implications of this data. We have a few questions about the nature of China's overseas lending and engagement. So first, from Stephen Morgan, there are difference in the proportion of Chinese and World Bank loans for extractive projects is huge. Is there any information on whether loan repayments are linked to tied export contracts to China? We have a question from Paulina about state-owned enterprises. Is there any significant difference in environmental and social performance of SOEs when they work through direct investment versus when they're funded with sovereign loans? And lastly, Mikkel asks about power infrastructure. We do track loans with sovereign guarantees. Moving forward, if sovereign guarantees are curtailed, such as in Zambia with the IMF package, how might that affect Chinese lending in the power sector? So I think we have a lot of technical questions about the nature of Chinese lending. I think whether our research answers those in detail or want to talk a little bit more broadly about what we know about the nature of Chinese lending, those are the two clusters of questions I would put to the team. So one, some data questions, and two, bigger picture about the nature of China's lending.
Tarela, would you like to start this time?
Sure, I can start with some of the kind of broader questions about the data. Specifically, I'll start with the level of transparency and kind of pulling together this data set. So when it comes to our methodology, we do use kind of a two-track system, meaning that we have a web scraper that helps us scrape sources across the internet to help us get a better understanding of the financial commitments that have been made to these development projects. Then we also check for sources manually by looking at official sources specifically to, again, gain more information about which loan commitments were given to a specific country and when that loan commitment was signed. We do all this because China itself does not systematically provide data at a disaggregated kind of format that is easy to understand. And so we kind of have to do this investigative journalism approach to finding details about these loan commitments. It does make understanding overall China's overseas development finance challenging at times, but we do feel like providing this public good is very advantageous for not only researchers, but for policymakers, especially in recipient countries as well. And we, within our policy brief and also on the data interactive, we do link to our methodology guidebook that can be found on our website. And then when it comes to, I think there was a question related to tied loans specifically. So of these two development finance institutions, some of their loans are used to support Chinese companies and Chinese companies' exports or services. So in many ways, yes, a lot of these loans can be tied. We don't provide information about the specific exporter, Chinese exporter it may be tied to, but given that there's publicly available information on these loans that can be found through a public search. And I think I'll pause there and kind of allow Becky to continue to answer questions such as mapped projects and others.
Sure, thanks. Ty, thank you for asking that question. It's an important clarification. The 736 mapped projects represent about 96% of Chinese finance that went into specific physical projects that would have a footprint. So remaining finance goes to things like general purpose lending for a treasury or a state development bank or even an oil company that's just, they could use that money for anything they want, or for a project that isn't necessarily tied to a building or a construction project. But 736 is the number of projects we've been able to geolocate with very high precision to within 25 kilometers. There's an additional smaller number of projects that want to support something physical, but that we haven't been able to map yet, either because there just aren't good enough satellite maps for some very remote areas, or because there isn't public information about specifically which roads were built or which part of a province received infrastructure finance. But the 736 represents 96% of the finance commitments that went to physical projects. So with that level of confidence, we can then use those locations. And in fact, in the data set that is downloaded, if you download the shape files for like geographic geospatial analysis, it includes information about the level of precision that we have for our knowledge of each mapped project. If a number 1 in that variable is going to mean we found it exactly, we tagged it exactly, we manually drew around this building complex, or we imported directly from public GIS maps about exactly where the boundaries are. Number 2 means we know it's within 25 kilometers of a particular point, but perhaps the construction hasn't finished yet, and so we don't know the precise boundaries, but we know where it is going. And that will allow researchers and hopefully stakeholders like community groups and nonprofits, as well as government, environment ministries, culture ministries, etc., to be able to track all of the aspects of a project that are so important to understand, to manage it well, and to get the best possible outcomes for everybody. Regarding Paulina's question, that is a fantastic question that we have not answered yet. State-owned enterprise activities through lending or through investment across those 2 avenues. And that's exactly the kind of thing that I hope this data set will enable other researchers to do. Our goal isn't to use this data set to answer every possible research question within the center, but we're a small center, and we hope that by putting this data out there, we'll be able to support researchers around the world with different interests and research questions, looking at their own research questions. We do have recent research into both development finance and investment in the Amazon basin, treating them all the same, because some countries in the Amazon basin region prefer to get finance through lending and some prefer to seek investment. But we don't specifically even compare those 2 avenues in environmental risks or outcomes. But that's the kind of thing that I really hope that other researchers out there who can use this data, who can download the data, can explore using this tool that we're hoping to make public everywhere. Regarding guarantees, so in order to, again, be comparable to the World Bank's public debt accounting process, we include public and publicly guaranteed loans. So as guarantees change, we expect to see some shift in that as well. But we should acknowledge that public guarantees are not as transparent as direct public debt, and so we will try to follow those as they change. As you say, Torella may have more information on the guarantee side of things in particular. But if a project is not guaranteed, we absolutely would not include it. But we do try to include all of the what's called PPG, or publicly guaranteed commitments. Thanks.
Could I add something there? I think that question was from our friend Mikel Munoz, and he wasn't asking so much about the data. It was more of a Zambia specific question. So as these countries have more and more debt distress and increasingly go to the International Monetary Fund for emergency liquidity finance, will they be limited in their ability to provide guarantees, which are essential for sort of new power projects? That's how I I saw his question, and unfortunately, what he's hinting at is right. Of course, the devil's in the details of what a particular IMF program looks like. But in general, the idea is that a country is going to have less space to be able to provide guarantees and to have public outlays in any form as a part of a fiscal consolidation program that would be conditioned for the emergency finance. Now, the good news is that in 2021, the International Monetary Fund ruled that that climate change and climate change policy is macro critical, and so they need to integrate climate change into its policies and its lending programs. But it remains to be seen if certain sort of essential investments for new low carbon and inclusive growth paths can be ring fenced within an IMF program. There's a lot of work to be done there. Maybe we can put in the chat. We have the center has a task force on climate development in the IMF that isn't really related to the sort of China work, but it hits these kind of questions, and this is where this will overlap. Traditionally, an IMF program has really been all about fiscal consolidation, and to get to my other point, sort of the math isn't really adding up, right? So we need to figure out a way to turn this crisis into an opportunity to mobilize the finance for our climate and development goals. We can't kick that to the side the way that we have over the past 50 years. Whenever there's a crisis, we need to figure out a way, sort of the way we did here in the North, right? We had these big stimulus packages to get out of recessions, followed by a big package here in the United States, like the IRA. Unfortunately, the IMF philosophy is sort of dissimilar to that. Rather than stimulus-led investments to get out of a recession and a crisis, the IMF imposes this sort of fiscal consolidation approach, which our task force really feels like is inconsistent and misaligned with our Paris and SDG goals.
Thank you, Kevin, and thank you to Becky and Tarla as well for fielding these questions and sharing their thoughts with us today. We didn't get to all of the questions, but we hope that you'll stay in touch. I know contact info was posted in the chat, and you can also receive updates on our publications and events through email from the Global China Initiative. The link will be in the chat for that. Lastly, I just want to acknowledge our wonderful research assistants and fellows who have helped a lot with this database. There's an incredible amount of work and all of the verification, the double verification process, validating in multiple languages, many languages around the world. So thank you to our RAs, I think some of whom are here today. The webinar has been recorded on YouTube, and the link will be posted in the chat as the last thing. So thank you so much to everybody for joining us today, and we will see you next time.
Thank you so much.